Hablamos con Frederic Leroux, es el responsable del equipo de multiactivos y miembro del comité de inversión de Carmignac. Frederic, thank you so much for having us a few minutes in Negocios Televisión. Frederic, first of all, yesterday the Fed minutes were released and 50 basis points rate hike seem more likely for the May meeting, for the next monetary policy meeting. Do you believe this is what the economy really needs?
Oh, I think so. We really have to realize that we are in a very different environment than the environment we got used to over the past decades. We had a disinflationary world, or no inflation, and now we have clearly entered an inflationary period for divisions. One can develop this point. So how the Fed really has to address this problem, it has to make sure that inflation expectations are anchored, and for that they cannot afford letting inflation run too high and too long. Otherwise, this inflation anticipation would be de-anchored, and we can fear many bad events in the future. So the Fed, which was late to understand this new situation, really has to strike hard initially.
James Bullard, one of the Fed hawks, said today that Fed funds should really be at 3.5% now. Do you think the Federal Reserve will reach this level sometime this year?
So I think the Fed really has to increase rates at each meeting. The real question is by what kind of increment, but we believe that 50 bips for the next meetings, for each of the next meetings, will make sense. And so at the end of this tightening cycle, I think interest rates might be even higher than the 3.5 that some are fearing now. The situation is very different from the past 40 years. If you think of, let's say, the last 15 years, what we had was a situation where the central banks and the markets decided on the level of interest rates. If the markets were a bit too optimistic, the Fed increased rates a little bit, and if we had an accident in the market, the Fed reduced interest rates and was trying to purchase bonds in order to give liquidity to the market. Now things are very different. Inflation has become the boss. Inflation decides the level of interest rates, which means that we don't know where they are in 3 months, in 6 months, and even less in 2 years or 4 years. But after 40 years of disinflation or no-flation, inflation is back for many reasons. So I think that we have to be aware of the trend. It is very difficult, and much more than in the recent past, to know where the tightening cycle ends. But we have to be aware that this tightening cycle will be there with us for some time. And so it will have effects on the price of equities, of course, the level of long-term interest rates, and also inside the equity markets, we might see some relative behaviors between the growth sectors and the cyclical sectors, very different from what we've got used to.
And in Europe, the ECB has also released its minutes today. We see that the Governing Council still does not agree on how long inflation will last and still does not see stagflation in the European economy, but they do see what they call slowflation. What's your opinion on the ECB minutes?
On the ECB minutes themselves, no precise opinion, but what I would tend to believe is that the ECB is a bit in the same situation than the Fed a few months before, realizing a bit late that inflation is becoming a problem. And what is missing now in some countries in Europe is the participation of wages to this spiral between prices and wages. And at some point, I cannot imagine that wages stay as calm as they are now, because the increase in energy prices, in food prices, will reduce purchasing power by a very wide margin, and clearly there will have to be a reaction on the wage front. And so once you see that, you will see the ECB becoming even more sanguine, I would say, as it has been recently. And so I think it makes sense to be in a position to anticipate what the central banks will discover. I think anticipating that they will have to do more than they tell us they are going to do is probably the right thing to do, at least as an investor. It is especially true in the US, where wages are already climbing at a very fast speed, but it should become the same story in Europe. And we see in some countries some scarcity in terms of workers for many different specialties, and so we will see wage increases the same way we saw this developing in the US a few months ago. So I think that it is probably better to focus on the medium term, realizing that inflation is not there for a few months period, but probably for something more important, more long-lasting. We have to be ahead of the curve, ahead of the central banks, I would say.
And Wall Street earnings begin next week, and as always, the first will be the banking sector. Will they change their guidance, their outlook for this fiscal year after the more aggressive moves that are expected from the Fed?
I think that there are two aspects that can become negative over time, which are interest rates. So for the companies that are indebted, at the end of the day, you can see interest charges which will climb over time and will be a detractor to earnings. And you also have wages. So for different sectors in the economy, wages will be a heavy weight in terms of profitability in the future. So I think we have to be aware of these sectors which depend very much on the price of the labor. And so it is not necessary for this quarter or this first half that things will be very obvious. But we have to realize that in the medium term, as long as we see this inflationary trend still alive, we will have to anticipate that wages and interest rates will be a detractor to earnings in the coming period. We come from a very positive period in terms of profitability. Things might change over time, gradually. At the same time, interest rates are climbing. And so I think the environment becomes a bit more challenging than in the recent past, even if it was already very volatile. I think, yes, now things are probably a bit more challenging than what we got used to.
And finally, in a few days, we will get to know the CPI reading for March in the US. Last reading was right below 8%. What can we expect for inflation this March?
So I think we are close to a peak for this short-term cycle. We are close to 8. Probably March might print just a bit higher or just a bit lower. But in the coming months, we should see inflation coming down a bit for a certain period of time. It will not prevent the trend from staying positive for the coming years, but we will have a respite. And it will be very interesting to see if inflation is in a position to come down sharply or not. My guess is inflation will prove more sticky, more resilient. And it is probably why, when the market realizes that inflation is more resilient, even if we have an economic slowdown, that interest rates should take a very different path towards much higher levels. Because for the time being, what the central banks anticipate, what the market anticipates, is that in 1 or 2 years from now, the inflation situation will have normalized. I am not sure this is the right way to understand the economy now, It is probably the case, but I think there is a real possibility that it is not the case. It would mean that even if you have a slowdown in the economy, inflation will stay sticky and probably much higher than what the market is currently expecting for the coming, let's say, 6 months. But in the short term, we are, I think, close to a peak.
Close to a peak of inflation. Thank you so much, Frederic Leroux, responsable de negocio de multiactivos, miembro del comité de inversión de Carmignac. It's been a pleasure.
Thank you. My pleasure too. Thank you.